Okay, so how do you do a trade? First of all, I'm sure you've already opened up your brokerage account, since one of our concepts is we don't take your money. So you have your own brokerage account, and therefore you're in control. So if that account is funded, then you can look at deciding how we're going to execute a trade. Well, if you go to the Done For You tab on the website, look at the Opportunity tab. Here we present the trades for the week, and if you study that format, it's very straightforward. We present the information in a way where it shows you to buy the stock, and the data that we present is since options require you to buy 100 shares, that's one contract, one option contract. You'll note that everything is rounded to 100 shares, and that we will try to invest or show the example as close to $10,000 as possible. That's by design. If you have, if you're going to do more, that's fine. There's no issue there. We're not recommending 10,000. It's the way we are presenting the information so that you can scale it to whatever you want. So we basically pick the number of shares to get close to that 10,000, maybe above a little bit, maybe it's 11, but that gives us a way then to always look at opportunities one against the other when we look at the return, because the asset value is basically the same. The next thing in that table, you'll see we're saying we're going to buy the stock, number of shares, and then we're going to sell a call option, okay, which basically tells you the number of contracts, and based on the system information, it's showing you the strike date that we're going to sell at, how far we're going out on time, and the strike price. Now, this is all based again on a lot of mathematics in the background, and we really don't need to get into all that detail because might get you confused, okay, and what the objective is. The objective is to buy the stock, sell a call option going to have the highest success factor for you, and move forward. So we don't want you going and trying to fine-tune the information. You'll spend more time trying to fine-tune it and less time executing good trades. So we suggest look at the information that's provided on the website, take that as a guide, buy the stock, sell the call, and there's another line item that says sell a put. Same thing. The system is identifying the strike date and the strike price that has going to have the best success. So we're doing a whole set of mathematics behind the trade setup to give you the best outcome. And then the last line is saying we're going to sell the stock at our call strike. So now we have a kind of a full cycle of each opportunity that's being presented. So the information on the website is a guide. That's a starting point. So if you have that available, then you can go to your brokerage account and say, okay, I want to present the trade, I want to execute the trade, okay, as identified. So you go to your platform, you buy the stock, and the prices are going to be a little bit different than what we're showing on the website, but that's the nature of the game. Everything is dynamic, okay? It changes by the second, by the millisecond, really. And there's no way you can control that. What I'm trying to point out is that if you look at I'll call it the average of a group of trades, you're going to get pretty close to the same average that we're getting. Some may be a little bit better, some a little less, but on the whole, the key is to look at the average. Don't try, if the website says you can get 1.87%, okay, and you're looking at the data and you're getting 1.85, that's pretty close, okay? Don't try to get 1.87 because you may not get that trade completed. And time is valuable. Time is money, so to say, okay? You want to do this basically in a cycle that gets you completed in a short period of time. So at your brokerage platform, you buy the stock, you put in the order to sell the call, okay? Because you want ownership of the stock first, okay, before you place the call. If you didn't do that and just sold the call, you basically would be naked on the call. And what would happen if the stock price just whatever jumped up? We had an example today. Amazon just put a bid in for Whole Foods, right? The price went up, what, 20%? Now, you can't predict that, so you don't want to get yourself into that situation. You want to buy the stock, put the order in to sell the call, and then look at the prices available on your platform. I mean, your brokerage is participating in the market, and there will always be a bid ask for what you can get for your option. So you need to look at the bid ask, and if it's a very narrow range, it might be, 25 cents to 30 cents. You're better off going in and saying, I will sell that right at 25 cents. Get your premium in your hand, okay? Because 10 minutes from now, the stock price may change and you may only get 20 cents. So it's better to take what's available, because like I said, in the long run, if you look at the average of 2 or 3 trades, you're going to be better off. So look at the bid ask on the option, because the Wall Street Winning system told you which strike price and which strike date to look at. It's just that the bid ask is going to be a little bit different. So you want to get that position completed by selling the call. If the bid ask has a big range, let's say it's 50 cents to $1. Okay, now that's a 50 cent. That's a big spread. What you need to do there is look at the midpoint. Well, what's the midpoint of the two? The midpoint's 75 cents. So you put in the limit order, sell at 75, and as soon as you put that order in, the market, the stock market will adjust, okay, to the fact that you're willing to sell it for 75 cents. That's halfway between the 50 cents to $1. In a lot of cases, what happens right away, I mean, right as soon as you look at the next bid ask for that option, you'll see the price may now be 50 cents to 75 cents, right? The upper ask has gone down to 75 because you were willing to sell it at 75, but the bid 50 cents is still there at 50 cents. So now you see the range is now 25 cents. If you wait a minute or two and see what happens, okay? Will your order get filled at 75? It may or may not, depending upon what's happening with the stock price. But let's say in a couple of minutes it doesn't get filled. Now you need to reevaluate and look again at the bid ask, look at the midpoint. What's going to happen is as soon as you move down to maybe halfway between, which is what, like 65 cents, close to it, you put in an order for 65 and bingo, you get filled at 65. Well, you pick the midpoint again. See, so now the market is adjusting to what you're willing to sell the call at. So the key is not to assume you're going to be able to always get your price, okay, and say, well, I'll just wait all day to get my 75 cents. I say that's a bad idea, because you may wait all day and the market goes against you, and now when you look at your bid ask, it's 25 to 50 cents, right? And if we sold it at 65, we would have done very well. So the key is not to try to say I'm going to squeeze every penny I can, out of the market. In most cases, you're going to lose more of the time than you're going to win. So the key is to execute the trades, because if the price that you bought in and the options available right now, there is a relationship, and that relationship is very close to what is being presented when you looked at the initial opportunity at Wall Street Winning. It's a ratio. It holds very well. So the key is to get the trades executed. So once you've done that, then look at the put. In other words, we want to get buy the stock, sell the call. The next thing now we're going to execute is we're going to sell a put. Okay, so now we're going to look at, again, at Wall Street Winning, what is the strike date, strike price for the put? And if the market changed a little bit, it'll be updated at Wall Street Winning. Okay, so again, we look at that as a guide. Go to our brokerage platform, look at the put opportunity for that stock. Look at the strike date, strike price, and there again you'll find a range, a bid ask. Do the same thing. If it's a big wide spread, maybe 50 cents or more, go to the midpoint. If it's a nickel to 10 cents, most cases you can go in even at the market and you might get the midpoint. The key is to complete the trades in a reasonable period of time, because you're going to, in the long run, you're going to perform much better, because you're going to take what's available at that particular point in time. And if you do that, I think over time you're going to be more successful. If you try to squeeze, like I said, more pennies out of the market. Sometimes you're successful, but I suggest that it's probably more risky in the sense that over a long period of time you're gonna gain less. So get the trades done in that form, and once you've got the put done, that opportunity you've completed. Now you can look at the other opportunities and do the same thing, and you might put them in one after another. In other words, you may say, buy on the position, sell call, sell call, sell call, sell put, sell put, sell put. And you're done if you did the 3 trades, and done for you. You're done basically for the week, okay? Your job is done. You can go on vacation now. You can do whatever, okay? You had basically a set of premiums that you've now collected. They're yours, okay? And you own some stock, you own some equities that have value, because one of the things that the data is presented to you is we've done all the sorting and filtering to make sure that the equities that are being presented have sustaining value over time. That is, that's going to be the keys to success. And we'll get into the what and when discussion shortly. But anyway, the key is to now, in your process of reviewing the data on the website, you'll notice that done for you in the different offerings, Basic, Plus, and Pro, there are a different number of opportunities presented. You can take a look at those, review those, go to your brokerage platform to execute. And then look at the trades open. Because if there are trades that you've done in the past and you might be in an open position, it'll tell you exactly what we plan to do. So on Monday morning, for example, there are planned events of which call to sell, which strike price, which strike date, and it's all designed to try to make sure that we generate a positive result. If you look at the trades completed, you'll notice that we always gear, the goal is if something goes against us, the next step is we're going to try to get to break even. So every trade setup that you're looking at has a break even number. We know exactly what the stock price has to be at, for I'll call it that particular cycle of an equity call and a put, what it takes to break even. And that's very important, because we would rather, if something goes against us, get to break even in a week or two versus selling now and take a significant loss. There's no need to do that. The underlying equity has significant value, and the stock market is the stock market. Prices go up and down. We don't control that. But we have a way to exit trades successfully to always, give you a very positive result. And that's going to be key as you move forward in time, okay? And once you look at some of those trades and trades completed, it'll give you a better feel, okay, for what the next process will be. And that way you can learn by reviewing. And you also learn by doing, in the sense of looking at the trade opportunity and start, I would suggest the first step is do some paper trading. Actually go to your brokerage account, write down the prices you could get, and if you have a bid ask that's 50 to $1, assume a midpoint, like we just the example I took, okay? Assume you get 75 cents, which is maybe even higher than was possible. But that way you can look at, when Friday comes around, how successful would that trade have been. You could also look at the website on the following Monday, and you'll see what happened to the actual trade itself. So that way you have a feel of what you would have done, what prices you would have obtained, and what your result would be. And basically, my feeling is you'll be very close on an average to what Wall Street Winnng got in the trades if you did a cycle, for example, in a week, just to learn. It's a learning process. You learn by doing. And even before you commit any money, it's good to go through that exercise. So with that, I hope you're able to start looking at the data and start learning of how to use the data from the website and as you go to your trading platform.